Welcome to Zitron Squeeze, where AI hype meets the balance sheet. A lot of the AI story still sounds like physics and destiny, but the pressure is showing up somewhere less glamorous. Bond spreads, memory prices, lease obligations, and the fact that nobody wants to say exactly how much money this is making. Start with Blackwell, because this is the cleanest example of how headline claims mutate on contact with reality. Jensen Huang pitched as much as a 25 times reduction in inference cost. That sounds seismic, but the follow-on case studies pulled that closer to 10 times, and even those examples came from private providers that are not profitable. That does not mean the chips are bad, it means there is a big gap between technical efficiency and business viability. A model can get cheaper per token and still fail to become a good business if customers won't pay enough, utilization is uneven, and the surrounding system cost keeps climbing. So the right question is not whether Blackwell is more efficient, it almost certainly is. The question is whether those gains survive the full stack, all the way down to margins and cash flow. So far, there is very little public evidence that they do. Now zoom out to the hyperscalers. Between 2022 and 2026, the four biggest players are said to have added about $850 billion in property, plant and equipment. Capex running at roughly a quarter to almost half of revenue is not a normal background condition. It's a strategic bet of unusual size. On-balance sheet debt rose by more than $300 billion, and the off-balance sheet commitments are even more important because they are easier to wave away in the narrative. Google alone reportedly has more than $800 billion in future spending contracts, and total off-balance sheet obligations are above $1.35 trillion. That does not prove a crash is coming. These are giant companies with real cash generation, but it does change the standard for success. When the fixed commitments get that large, AI is important is no longer enough. It has to pay back at a scale that justifies the financing burden. Credit markets are useful here because they are less interested in vibes than equity markets tend to be. CoreWeave's $1.25 billion bond reportedly trades at a 756 basis point option-adjusted spread for a Ba3 credit that is far wider than the 200 to 400 basis point range you would normally expect. In plain English, lenders are demanding panic pricing. SpaceX bonds sitting around 270 to 350 basis points, despite being talked about as investment grade, tell a similar story. The label matters less than the spread. Bond investors are not saying every AI-adjacent borrower is doomed. They are saying duration risk, execution risk, and leverage risk are being repriced. That's different and more specific. There's also a supply chain problem buried underneath the compute story. AI servers such as the NVL72 reportedly need more than 20 terabytes of high-bandwidth memory. That level of memory demand helped push Micron to raise DRAM prices by 60% in a single quarter. Even if the exact pass-through varies, the direction is obvious. Memory gets more expensive, servers get more expensive, financing needs rise. And that matters because the bullish case often assumes compute gets cheaper fast enough to outrun demand growth. But if a critical input inflates at the same time, some of the efficiency gain is immediately eaten. This is the second-order effect people skip. Better chips can coexist with worse economics if the ecosystem around them becomes more capital-intensive. The NVIDIA, SoftBank, OpenAI financing story is where the skepticism gets more structural. A reported $250 billion guarantee for a 10-gigawatt data center plus $350 billion in GPU financing would depend on a lattice of special-purpose vehicles and backstops. The comparison to Lucent and Windstar is not about saying history repeats exactly. It's about recognizing a familiar pattern, vendors, customers, and financiers becoming entangled enough that the apparent demand starts depending on the financing architecture itself. If there is little real construction underway, and if the debt needs to be raised over decades, feasibility is not a minor detail, it is the whole question. Maybe some version of this gets built, but on the facts provided, the burden of proof sits with the optimists. Then there is the simple issue that a lot of AI startups and neoclouds appear deeply unprofitable, even at scale. Labs charging $8,000 to $14,000 a month while losing billions are not proof of future monopoly economics. They are proof that revenue exists. Those are different things. CoreWeave posting a $740 million quarterly loss despite repeated debt raises points to the same tension. Growth can be real and still not be self-funding. The optimistic margin story often leans on projected 30 to 40% gross margins, but that usually assumes very high and very steady utilization. In infrastructure markets, utilization is where fantasy and reality tend to part ways. Idle capacity is poison, so is customer concentration, so is a price war once enough supply comes online. One of the strangest parts of this cycle is that the hyperscalers still have not clearly broken out AI-specific revenue, despite the scale of spending. That absence is not dispositive by itself. Companies do not always segment emerging businesses neatly, but when investors are being asked to underwrite extraordinary capex, more disclosure would normally strengthen the case. The OpenAI on Azure number is a good example. If $17.2 billion of spend represented 69% of Microsoft's cloud growth in a year, that sounds huge until you remember the base is enormous. A major customer can drive incremental growth and still remain a small share of total cloud revenue. That is why executive AI talk deserves pressure testing. Plenty of leaders proclaim transformation while admitting they barely use the tools themselves. Media amplification then turns aspiration into assumed fact. The weakest argument in this whole cycle is everyone important says AI is changing everything, therefore the economics must be working. That argument is not supported. The correction thesis is basically that if AI capex falls below the level needed to sustain this financing machine, credit shuts first, equities react second, and the overhang of leases, contracts, and debt becomes much harder to ignore. That is plausible, especially with spreads already widening, but the timing is genuinely uncertain because hyperscalers can keep spending longer than smaller players can stay solvent. The longer-term risk is overbuild. If planned capacity around 190 gigawatts ends up far ahead of verified demand and projects take 2 to 3 years to come online, you can get stranded assets before the market fully admits it. So the balanced conclusion is pretty straightforward. There is real technology progress here. There is also a financing structure that increasingly looks fragile, opaque, and dependent on future demand arriving at exactly the right speed. Right now, the evidence for technical improvement is strong. The evidence for durable, sector-wide economic returns is much weaker. That's it for this one. Thanks for listening to Zitron Squeeze. The chips may be faster, but the math still has to clear. This episode was generated by Podkey. Create your own at podkey.fm.